Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. India's out-of-pocket healthcare expense is still one of the highest in the world. As per the last estimates that I read, about 63% versus the world average of sub 20%. A lot of people anticipate the situation will change substantially over the next decade, given the strong opportunity and estimates that gross retail premium for the health insurance industry will grow from where it is right now, about 258 billion, to over 1 trillion by FY30, which is a potential CAGR of over 18%. Well, it seems to be that the health insurance industry is therefore in a sweet growth space. Let's talk to arguably the leader of the pure health insurance space in the country, Star Health. Mr. Anand Roy joins in. That they did their AGM and came out with an annual report and gave us some feelers of what they feel about the growth is purely coincidental. Anand, great having you. Thanks for joining in. Hope all is well.
Thank you, Neeraj. Good morning, and thanks for having me.
The pleasure is ours. Anand, I read a powerful line in a summary of your annual report by a broking house. It says that after the lifting of COVID-related restrictions, there is a growing acceptance of the need for hospitalization, leading to larger customer walk-ins without the need for being prospected. Are you therefore saying that in a space which is likely to grow 18, 20, 25% as the case may be over the decade, the need for prospecting is also reducing as well?
So we have seen a change in the mindset of the insuring public after the COVID pandemic of 2 years, where health insurance has become something that people are willing to invest into. And they are looking at opportunities to evaluate various products, various services. And definitely it is a area of interest for most of the, middle class and the upper middle class segment, which is our target segment as such. So yes, relatively to pre-COVID, I would say the awareness factor has definitely increased. But insurance, nobody wakes up in the morning with a sense that they want to buy insurance. It's still a push product. So we have a distribution network which prospects customers, makes them aware of the various products, and then eventually makes a sale.
Okay. What's your sense on the slightly long term? I mean, the estimates vary. The thing is, I've read about these estimates for life insurance for years now, and probably some people would still argue that it's a very underpenetrated category. Somehow, it's not necessary that growth happens in the same linear fashion that people anticipated. What's your thought around this for the current moment for the health insurance sector as well as for the decade ahead?
So when we look at the headroom for growth and the awareness that has been created and the current levels of penetration of the health insurance business in the Indian market, obviously everything projects that the opportunity is substantial going forward. Now with the new the regulator is also extremely interested in increasing the insurance penetration, and they are also taking various measures to free up the space so that more and more people can be covered. So I think the opportunity is substantial. I think in your opening remarks you mentioned that more than 60% of the healthcare expenses is still out of pocket, and the highest in the world actually. So I think it is up to the health insurance industry and the various companies. How can they design products which are relevant to the market? How can they make sure that the trust of the customer is gained so that the people believe in insurance and they invest in it? I think these are definitely opportunities for the future. So we see as a company a very, very long headroom for growth, and we believe that the kind of establishment that we have created over the last 15 years keeps us in a very, very strong wicket to play a significant role in this growth opportunity.
You speak about the past. I mean, I believe, as per what I read, that your retail GWP is probably 3 times the retail gross written premium for the next house retail insurance player. Now, does that give a base effect drawback to you, or does it give you the size effect to be able to grow even faster as India wakes up to the underpenetration?
I think I would say that it gives us a size effect that makes us grow faster, because health insurance is a business of trust, and having a large market share, having a very granular level of distribution and services across the country gives us a wonderful opportunity to create that momentum where we can grow faster than the industry, and thereby have gain market share even every year. But yes, the base effect, we are three times larger than the next largest player. Probably one of the few companies in the financial services space having such a large market share in any segment. So I think that is definitely positive for us, and we look at this as an opportunity to keep growing faster.
But interestingly, and data can be sliced in multiple fashion. I looked at one slice of data in a report. It showed that the ex-PSU market share, the gains for you in the pandemic years, relative to the gains that some of the others made, were starkly different. I think your numbers moved from a 26.9% ex-PSU market share to 27.8. So you gained in the last 2 years, or till FY22, but the gains made by some of the others were more. So is there a reason? Have you kind of seeded some places voluntarily? How has it worked in the last 2 years at least?
So we are focusing on the retail market share. We are not so much focused on the overall insurance business market share, because that has we have consciously taken a decision to go out of certain segments which is not profitable for us. So I think in that context, we are not so much bothered about this particular data. But if you look at the retail market share, we have been consistently increasing our share of business every year and every quarter, and we will continue to focus on that segment, which we believe is actually relevant to the Indian society at large, because the penetration levels in that segment is most required and most desirable.
And hence the cutting down of the group insurance business. I mean, I think you also mentioned that on the group side, you will probably focus only on the SMEs, but exit the large corporates. So can you give us a bit of a breakdown about what led to this thought process? And I'm guessing the impact of this may not necessarily be felt immediately on the quality or the overall texture of the business, but maybe comes in over a period of time. Can you kind of lay it out for us, if you will?
Yeah, absolutely. So see, the group business, the corporate business, basically has been one of the largest play in the health insurance segment ever since the business started, opening up to the private sector 20 years ago. But we have seen extreme high competition in this corporate group insurance business. But we were also participating in that prior to pandemic, because there was certain levels of competitive advantage that we had, and the services that we were able to offer. We were able to gain some good markets and good corporates. But what we saw during the last 2 years, especially after the pandemic, is the pricing and the competitive intensity really increased in this particular segment. And what happened is, in the insurance business, as most of the other lines of business slowed down with the lockdowns and all of that. So, and health insurance grew, and the fastest way of growing your health insurance share was the group health insurance segment, for every company which did not have a very strong retail distribution. So I think the competition increased many folds, and as a pure play standalone health insurance company, we evaluated this, and we felt that it is not worth participating at the current intensity and the current market rates. Probably we will look at it in the future, but we are not totally out of it. As you rightly said, we are looking at the SME segment, which is the small and medium enterprises, probably 100 employees. That's a target group for us, and which typically comes from our traditional distribution channels like our agency and our bank assurance partners. We are able to align with them, and we are able to target this particular segment. So currently, this is the strategy. We will see how the situation evolves, and probably take our decisions based on that.
How does it impact the overall granularity or texture of the business? Can you tell us? I mean, compared to what has been, what do you expect it to? Because you would have taken the decision based on some hypothesis of where you want to reach on certain parameters.
Yeah, absolutely. So the single most important agenda was to reduce losses, which is arising out of this particular segment, and we have achieved that to a large extent over the last 6 months when we started. Over the last 9 months, you can say, when we actually took this decision to exit this particular segment. So I think we have achieved what we wanted to achieve. But as far as the SME segment is concerned, we believe that there is more scope to be done, work to be done, and we are working on various channels and various partnerships in that particular market. We have not, really done as much as we would have liked to as far as the SME group segment is concerned. But I think the large corporate segment, the decision that we took and the targets that we wanted to achieve has been kind of completed.
Oh, so excuse me for not being on the ball on that completely, Anand. But what I gathered was that even Q1 that went by, for reasons of the group exposure coming off, impacted the overall numbers, and there was anticipation that it may continue for a bit. I now hear you say that most of the good impact that you wanted to achieve from this has been achieved. So therefore, my question then therefore would be: do you reckon that even the reduction that happens as a result of moving out of the group businesses possibilities, is that negative impact also now behind you at the end of quarter 1, or could that last for a quarter or two more?
See, the headline growth numbers definitely has taken an impact because of our decision to exit the large corporate segment, and
Yes.
we are seeing that in our numbers as we speak. But that will continue for another quarter because, as you know, the entire business has played out over the last financial year, and we will have to take a decision in the future quarters also whether to. So we are, as I told you earlier, we are not exactly ignoring this segment.
Yeah.
We are participating, we are quoting, but we are not winning many of the accounts because of the current competition and the rates. So I think that will happen in the next couple of quarters also. Probably from the next financial year, the financials will kind of even out the
Okay,
growth rates.
but the positives on the parameters that you wanted to achieve, that you achieved currently itself. So even if the headline numbers comes off, the granular numbers will have already gotten you where you wanted to be because of this decision that you've taken.
Absolutely, you're right.
Okay. Okay, thanks. Now, you mentioned in one of your answers, Anand, that both the agency channels and the banker partners that you have enable you to get a foothold into the SME as well as the other business that you want. There were, I think, in all the three reports that I read for your business, they all spoke about how you will increase, or you will have to, and you are increasing the focus on banker offerings, because that's not, I mean, your agency is your strong suit maybe relative to the banker tie-ups that you have. And I believe your annual report also says that you upped the RMs for the banker tie-ups. So can you tell us a bit about how does this piece move, and if indeed the banker channel increases in share over a period of time, is it return dilutive relative to the agency channel? Is it margin dilutive or no such stuff?
Okay, that's a very good question. Thanks for asking me. Yes, agency has been our mainstay. Even today, 80% of our business comes from the agency channel, and we like this channel a lot because it is a granular distribution, right? So you're not dependent on any large partner or any large player who can substantially disrupt your business model. But having said that, we are looking at the banker piece as a very, very strong growth opportunity for us because we have been kind of, behind the industry as far as the bank assurance business is concerned. As a leader in the business, we believe that we should be up there with the rest of the other players. So we are looking at this business very, very, strongly. But the the vision of the company and the culture of the organization is that we do not want to enter into any partnerships which do not create value for the organization. Okay, we are
Okay.
not in it for only top line, and that's why we have had to let go of many such partnerships and many such discussions which were not making sense to us given our core values and our core understanding of the business. So we are very happy with the partners that we have now. We are working closely along with them, and even most of the bank partners now understand that health insurance as a business is very, very long term, sustainable in nature, and it is a value accretive for them also and their customers. And I think that mindset has come in already in our bank partners. We believe that the share of banker business will grow faster than the rest of the business, but definitely agency will continue to be our mainstay.
Yeah, but no, which obviously will be the case. But I'm just wondering. So if banker grows faster, but you are very selective in your banker tie-ups, would mean that it will not have an impact on the overall parameters, whatever the parameters that may be, that may typically get impacted with larger players coming in and demanding a slightly larger pie of the action.
So in health, Neeraj, we are the largest player, so we do demand our share of business whenever we have the partnerships. Of course, the most of the private sector banks have their own JV insurance companies where they have a natural affinity for each other's business, which is but understandable. But yes, having said that, we are looking at the bank assurance business to grow our benefit products book, okay, which is basically when we have our critical illness products, you have those long term benefit products which are given along with the bank loans. We are also looking at the CASA customers to custom make some of the products which is relevant to their customer profiles. So these are some of the areas we are focusing on. We believe that this will be value creative for us. It will not be destructive in nature, because this will also be a highly profitable channel for us.
Got it. Okay, so I mean, I have tons of questions, but let me try and whittle it down so that we don't take more of your time, Anand. Just one final set of questions, or one final question, and that is, keeping all of this in mind. If I'm not wrong, you guys have laid out that you are confident of growing the retail health book at a 20-25% CAGR. Now, please correct me if I'm wrong, of course. And in the same vein, I read, as I said, in a bunch of reports about how uh, the industry as a whole, over the course of the next 7, 8, 10 years, could grow at a CAGR of about 19-20% or over 18%, as the case may be. Now, my question is, these growth targets that you have, if indeed you say these numbers, are they for the very near term, which is the next 1 year or a year and a half till FY24? Or do you reckon there is longevity to this kind of growth for a better part of this decade? Or is it even possible to predict that?
So, definitely in the medium term, we believe that this is doable. At least till the next 3 to 4 years, we believe that 20-25% growth in the retail segment for Star Health is a doable number, because we have seen, now with the kind of demand which we are seeing, and the kind of conversions we are able to notice, not only on our traditional channels but also on the online digital piece, on the bank assurance piece, on various partners who are willing to tie up with us for distribution of health insurance products. I think these kind of growth numbers are definitely in the medium term doable. In the long term of towards the end of the decade, see, the aspiration of the industry is to increase the penetration of insurance business, right? And I think, as a leader, we believe that we will grow faster than the industry. Now, whether it will be 20%, whether it will be 25%, or whether it will be 18%, time will tell. But I think, given our strengths, we should be able to grow much faster than the industry.
And you will do this and simultaneously improving your OPEX ratios, maintaining the ROEs, or either taking the ROEs to higher teens, all of that at the same time while you're growing at that pace.
Absolutely, Neeraj. As I told you, the vision of the company is to be a profitable business, and we were a profit-making organization prior to COVID. When the COVID hit us, obviously all insurance companies took a big hit. But the first quarter of this financial year, we have seen that the business is coming back to our pre-COVID levels, and we believe very strongly that this will be a sustainable profit-making business, because we have been in the business for the last 15 years. It is not a startup. We know how the business has to be managed, and we believe that it can be done in a very, very good fashion.
Well, we wish you all the best for that, Anand. Thank you so much for taking the time out and speaking to us today on Talking Point. Lovely having you.
Thank you, Neeraj. Thank you for having me. Good day.
It was ours. And viewers, thanks for tuning into this leg of the Talking Point.